On March 9, 2009, the S&P 500 hit 666. 11 years later, it touched 3,386. That's 5 times your money. The longest bull market ever recorded. And yet, the average investor barely beat inflation. So where did all that money go? Here's the strange truth about that decade. The market handed people a once-in-a-lifetime run, and most of them fumbled it. Today you'll see exactly how they did it, and the simple discipline that would have kept you fully invested when it counted. Rewind to March of 2009. Fear was everywhere. Banks were failing, Lehman was gone, and headlines screamed the end of capitalism. On March 9, the S&P 500 closed at 676. That was the exact bottom. And almost nobody bought. Investors were doing the opposite. In the first quarter of 2009, they pulled billions out of stock funds and piled into cash. They sold at the bottom. Then they watched from the sidelines as the recovery began without them. And here's the part that stings. The market didn't wait for anyone to feel comfortable. It just went up. 23% in 3 weeks. 64% by year-end. But here's what nobody tells you about that first year. Now, the strongest data point of this entire video. Over the last 2 decades, if you missed just the 10 best days in the market, your returns got cut roughly in half. Not by a little. In half. Think about that. 10 days out of thousands. And here's the cruel twist, those best days almost always come right after the worst days. 7 of the 10 best days happened within just 15 days of the 10 worst days. So the investor who panic sold during a crash didn't just lock in a loss. They guaranteed they'd miss the rebound. The rebound was the reward for staying. Miss the storm, miss the sunshine. Which raises a real question for you. When the market drops 20% tomorrow, do you sell to feel safe, or do you stay invested? Tell me in the comments, sell or stay. Here's the counterintuitive truth most people get completely backwards. That 11-year bull market never felt safe. Not once. There was always a reason to sell. In August of 2011, the US lost its AAA credit rating, and the market dropped sharply. Everyone said the run was over. It wasn't. In 2018, stocks fell nearly 20% in a matter of weeks. Everyone said the run was over. It wasn't. The market climbs a wall of worry. That's not a slogan, it's the whole pattern. The people who waited for the all-clear signal never got one. They waited 11 years for perfect conditions, and perfect conditions never came. And the investors who stayed? They didn't need to be brilliant. They just needed to not flinch. Remember what I said at the start, the market handed out 5x returns. It gave them to the patient, not the smart. So where did all that money actually go? Studies of investor behavior over this period show a painful gap. The market returned around 14% a year in that stretch. The average stock fund investor captured far less because they bought high, sold low, and jumped in and out. This gap has a name. It's called the behavior gap, the difference between what the market returns and what investors actually earn. And it's not caused by bad stocks. It's caused by good people making emotional decisions at the worst possible moments. The dollars didn't disappear into thin air. They moved from the impatient to the patient. Exactly like Buffett said. This is educational, not advice, and you should always do your own research. But the pattern is as old as markets themselves. Remember what I promised at the start, that the longest bull market in history made almost no one rich. Now you know why. It wasn't the market. It was the flinching. The greatest returns of a generation went to people who did the least. They didn't predict the bottom in 2009. They didn't dodge the dips in 2011 or 2018. They just stayed. Here's the line worth remembering: the market rewards the seat, not the trade. So be honest with me, if you'd been sitting on cash in March of 2009, would you have bought or waited? Sell or stay? Tell me in one word below. And tomorrow, we're breaking down the crash that ended this run in just 23 days. Subscribe so you don't miss how it happened.